What's going on, guys? Let's talk about some stocks, and more particularly stock charts. So a stock chart is history of price movement. That's all it really is. You can just look at the chart and just be like, bam, that's what the price was on this day at this hour, whatever your time frame is. But there are three different types of charts. The popular ones, of course, are the line chart, the candlesticks, and the bar chart. So my question is, what chart is the best? I have my own personal preference, but there is a certain strategical advantage that you can get from using bar charts and candlestick charts over line charts. So if you look at a candlestick chart versus a line chart side by side, and we'll just use Tesla here for example, you can see that you get a lot more information by using a candlestick chart than a line chart. See, a line chart just takes the average over price movement for one day, and it draws a line from day to day and connects dots. In order to take your trading to the next level, you need to be able to see more information. The way that you're going to be able to give yourself an edge by looking at charts is by using either candlesticks or bar charts. So when you put a candlestick and a bar chart next to each other, they look very similar. And that's because they're telling you the exact same information. You're just looking at it in a different way. So a candle will tell you the exact same information. It just looks different. Remember, we're using a daily chart here. So if you zoom in on one bar or one candle, it will tell you everything you need to know about what happened in that one day. So the length of the candle or the bar is the exact same. The low of the day and the high of the day will determine the length of the candle. How they tell you where price opened and where price closed is the biggest difference between a candle chart and a bar chart. That middle section on a candle chart is how they determine where it opened and closed. I like to use bar charts because it's easier on my eyes when I'm looking at the full chart itself. There is not these like thick little lines between the open and the close that I see. It's just a tick on the left is where the open was and a tick on the right is where the close was. If it's a black bar, then it was a positive day. If it's a red bar, then it was a negative day. It's very simple. And then when you go into stockcharts.com, which is the platform I use to look at my charts, you can actually go in there and change the type from candlesticks to bar charts. I use OHLC bars, which stands for open, high, low, and close. In order to make it easier on yourself, you have to decide right now what chart you think is better to look at. But I promise you do not want to use line charts. You have to pick between either candlesticks or bar charts because that's how you get the most information. That's what all the institutional traders and investors use. If you choose to only use line charts, you're going to be missing out on a significant amount of information. You'll be at a disadvantage when you're choosing when to enter and exit trades. All right, so let's bring it back to the daily chart of Bitcoin that I was showing you. So if you look, this chart goes all the way back to April, late April. So you can see when the price initially crashed and everybody was freaking out about Bitcoin. And the whole time I was just looking at where did price stop and come back up and start to go sideways. So you can start to draw these resistance lines by looking at these pivot points and kind of where price had dropped too far. So if you draw these circles on each of these resistance lines, you can see where price stopped and came right back up. That's when buyers outweighed the sellers or sellers outweighed the buyers, vice versa. It pretty much is just a point on the chart where everybody else agrees that price has gone too far. I like to call it some sort of equilibrium of price movement, and it normally will be some sort of sideways action. So give you a moment to enter in or exit a trade. And I'll tell you this right now, you aren't going to be able to see those little lines on a line chart because all it is just taking the average of the day and it's plotting the lines. So you just won't be able to see the entire information, the whole picture, and you're going to miss those cues of when it's a good time to buy and sell. Finally, let's look at one of my favorite indicators. I talk about it in literally every single video, the RSI. When the RSI goes below 30, it's a good time to buy. When it goes above 70, it's a good time to sell or take profits. This is just a no-brainer. And you have to be using some type of stock chart software in order to look at this. You can't see it on Robinhood or Yahoo Finance. Looking at line charts, that's one thing, but you have to see the RSI because it'll tell you the velocity of which price is moving. You never want to buy a stock after it has just ripped up really high because it's likely to come back down. So when that RSI gets above 70, it means that price just went up way too fast and that a correction is coming. Or if a correction doesn't come, it means that it's going to stop and slow down going up. And I'm not saying time the market, right? Nobody knows what's going to happen tomorrow or the next day. It's impossible to time the market, but you can strategically use these indicators to help you pick a better price point. So I'll end with this. If you're watching this and you're just now getting into charts and you're learning about kind of like how you want to attack this strategy, don't be fearful. Don't be scared to get started. 72% of the time the market goes up, right? You don't want to be the guy that said, oh, I'm too scared to get in because it's already at an all-time high, because most of the time you're going to have to buy on an all-time high. You're not always going to get the greatest deal in the world. Like somebody will tell me, oh, investing in the market's risky. I can't deal with that risk. Well, honestly, I see it completely different. I feel like the risk is not investing. Like look at Bitcoin over the monthly chart. So each little bar you see here is 1 month. Like the price went from $100 all the way to $50,000. Like the risky thing is not owning Bitcoin. Owning it is not risky. It goes straight up. And if you think it's not going to go straight up and you're fearing this coming crash, then maybe you just aren't supposed to invest, because you could have said that at any point along the way in these last 10 years that the coming crash is coming. And look, it pulls back every so often, but over time it goes up. And it's going to keep doing that, because you have to understand, with inflation, with more people being born, with the scarcity of the price, there are people that are literally buying Bitcoin and they're never going to sell it. There's a dude that literally owns 1 in every 212 Bitcoin and he's never going to sell it. So if you don't own Bitcoin, you're taking a massive risk. And you can say that was about any stock too. If you don't own Uber shares, you're taking a massive risk, because you're putting yourself in jeopardy of living paycheck to paycheck the rest of your life. When things go straight up, you have to take advantage of the opportunity. So I'm going to wrap it up there. Thank you guys for watching. The reason I share you guys all this, by the way, is because somebody helped me and I needed to hear it. So maybe there's somebody out there that needs to hear it from me, because none of this would be possible if somebody didn't get in my ear and tell me that it was possible. If you're willing to work for it, a better life awaits you. Don't wait on the perfect opportunity. You don't have to get it right. You just have to get it going. So thank you guys for watching. I'll catch you guys next week for another stock market lesson.